Hi, this is John Parisi of Parisi Great Wealth Management. I'm the managing partner. Today is June 1st, 2023, and I wanted to take a few minutes of your time to give you updates on a couple of things. I'll talk about four things. I'm going to talk about the debt ceiling passing today. I'm going to talk about the concerns around the U.S. dollar losing its reserve status, which is probably another thing we know that's bothering a lot of investors. And then I want to give you a quick update and follow up on our May 17th market letter, where we changed our investment policy that we've held, which has been underweight equities for the past 18 months. And then on 5 weeks ago, we turned to target weight. Lastly, I just want to give a quick comment. You're seeing a lot of activity in AI and a bullish technology market, but we want to it's always fun in the short term, but we want to get eyes back on the long term. So on the debt ceiling, as we wrote in our last letter, one of the three reasons we were getting back to target weight is we knew the debt ceiling would pass. And I hope people can learn from this. We're going to say something here. It's going to be a blanket statement. The debt ceiling is always going to pass. It has to. The world cannot lose a risk-free rate. It is built into all the academic models of how you capital asset pricing model. Everything boils down to discounting present value of cash flows or an asset at a risk-free rate of where you can put your money risk-free. And it had always been the U.S. Treasury. It could be the overnight rate, the 2-year rate, the 10-year Treasury, but it's going to have to be there. And everyone in the government and the financial market system knows this. So you can always enjoy the political show on TV and the media hype around it. It's hype. It will always get passed. At some point, we're going to have to deal with getting debt down, but at 125% of GDP, that's not as extreme as it can go. Japan has run for years at 2 times 200% GDP and has managed fine. So that's that. Second of all, let's talk real briefly on the U.S. dollar losing its reserve status. Like the debt ceiling, it's not going to happen. Okay, it's just our view. It's not going to happen. You're hearing a lot of talk that, look who's talking about this. China, Iran, some of the bad rogue nations in Latin America, North Korea. These are people that have nowhere else to go. They're highly sanctioned around the world. And the clean, lawful countries of the world that have free market systems are trading around them. And they are getting choked off. So this is a natural defense mechanism on their part. The Chinese yuan, in our lifetime, I don't believe it can become a reserve currency. It just can't. Of reserve deposits out there, I think the yuan represents 3%, the US dollar 60%. It's going to take a lifetime for that to change materially. Second of all, it's not a free market capitalist system. It's a communist country. It's in their charters. I've done the work a long time ago. They have the right to go into any company that trades on a stock exchange in China, and the government can take the revenue or take over the company. They basically say that they own the company and they allow you to do business. Look at figureheads like Jack Ma disappearing and just leaving their companies when they become too big for their own britches in Western markets. So it's just not going to happen. It's just the rogue nations looking for a safe place to trade so they can modernize up too, but it's not going to happen. Quick follow-up on our update letter. We made the announcement after 18 months of being underweight equities, we shifted to being at market weight equities, which means a target weight. So if your target is 70% stocks and 30% bonds, we had you at like 60% stocks. 5 weeks ago, we got back to target weight. It's always hard after 18 months to do this. But as we came into this year, we were in the safety zone, underweight equities for 2022. That was the right trade. We did believe that 2023, and still believe it, will finish the year at a higher level. I don't know if it'll be much higher than now, but this was kind of the level we would hope we'd end the year at, up about 10% for the year. NASDAQ's up 30. But we thought it would be a second half of 2023 event. The first half of 2023 would be more of 2022 of choppiness because the Federal Reserve would not done raising rates. We now think the Fed is done. We don't think the Fed knows it, but we think they're done. Certainly done for June. There's talk they may go in July, but the Fed, if they don't raise in June, do not expect them to announce that they're finished and pausing and the next move is to cut rates. There gives them no sense to say that. So the world will have to live in limbo not knowing. But we're feeling good right now that they probably won't need to. Commodities, energy, gas prices, real estate, things are rolling over. Real estate's tricky, but with a 7% mortgage, the buying power is way down. We were underweight. We're not overweight. We're target weight. And if the market corrects heading into, like, say, September, October, as it often does, but maybe a recession starts to dig in, then we'll look to add. But we do think we finish the year stronger, particularly because 2024 is looking like a pretty good year for corporate earnings, and the market prices that in sometime between October and the end of the year. A little tax selling around October, November. That unwinds late November, December, and we hope to run into 2024 in a more normalized market of 9 to 10% a year, making more when you had some emerging market and high yield bonds and small cap stocks, stuff like that. So that's it. And lastly, I'll just close on this hype around AI and Nvidia and all the Microsoft and all the artificial intelligence stocks. It's been fun, but I can't emphasize these investments by us were made starting in 2017 in Nvidia and really in 2020. So at least 5 to 3 years ago, we made these investments to be an overnight success this last week. Microsoft, we've been buying back as early as 2010. We have a lot of positions from 2012 that are up eightfold, 8 times your money. 100 grand is worth 800 grand. 800 grand is worth 2.4 million. So you can see that stocks really pay off over the long term, meaning minimum 5 years, but you need to hold good quality companies for 10, 15, 20 years. Like today, we're not buying Nvidia hand over fist. If new money comes in, we want an allocation. We're laying seeds for what we think will be working 5, 10, 15 years from now. And then the main company we've been positioning, we put in our letters, is we're getting allocations to SpaceX. Elon Musk has Tesla, he has SpaceX. SpaceX has 2 components: the retrievable recurring rocket system that's going to lower the cost of going to space for military purposes, government purposes, media, right? Commerce. It's going to cost as low as $1 million a launch in the next 10 years to send satellites to space, or for corporate use, personal use, and for military use. Problem is, it's a private company. So we've really worked hard. We found a publicly traded mutual fund that has gotten access to shares. They're in most accounts right now. And then we've made some direct investments with SpaceX that we've found an ability to do that. And we'll continue to have offerings in that. And if you are interested in either one, do reach out to me. You do need to be a qualified investor with a net worth of $5 million or more and other criteria. But if you qualify for that, it's an exciting story. And that will be the Nvidia 5 years from now that everyone will be talking about. And it will IPO eventually. So just wanted to update you on that. It's a short week. I'm leaving tomorrow for a college reunion down in Washington, D.C. So it's Thursday night. And I wish you all the best. Call me with any questions. Thanks.